Okay, so since you may see one of you online, I'll just give a few minutes, okay? So in case somebody wants to join, they can join. Let's just give a few minutes and then we can start for the day. Okay, so since it's 6:05, I'll go ahead and start, okay? Right, so welcome to the TRG. Okay, so this is the third class that we're having for this season. And the first two classes, we looked at two separate areas of the syllabus, right? So what were those two areas? We looked at investment appraisal and we looked at cost of capital. Okay. Now, in addition to this, there are three more areas. One is working capital management, another one is business valuation, and the other one is risk management. Okay. Right. So since we have little exposure to MCQs and since the remainder of the questions that we have to look at come from, the three areas that I just mentioned, I think the best option that we have right now is to go through something called the pre-mock. Okay. So I'm not sure if you are familiar with it. I really hope that you guys are familiar with it. It's like an exam, a mock exam that ACCA themselves release just before an exam session. Okay. So I believe most of you must be sitting for September exams, right? So September exams means this is something that they release in the month of August, which is now, right? So it was released on the 12th of August. Okay, I hope all of you have had a try, have had a go at this particular paper. So the best way you should attempt this paper is basically under examination conditions. Okay, so you need to time yourself for 3 hours, do it under exam conditions, and make sure that when you're doing the paper, you don't do it with half knowledge, right? So make sure you have properly learned the syllabus and then you attempt the paper, right? So since this was released on the 12th, right? So it has been quite a while, more than a week ago. So hopefully all of you have actually had access to it. So now what we will do is we will go through the entire pre-mock exam. Okay. So we will start today. I don't think we can finish off the entire paper today. We should be able to finish a big portion of it though. The remainder we will finish off in the last and final TRG, and next week, of course, if there is more time, we will select some more questions and do it as well, right? So the reason why I am bringing this on the third week is because in case there is not enough time, I need a fallback option, right? I need another week where I can actually finish it off. Okay, that's the main reason. If not, you might be wondering why we didn't keep this for the last day, because the last day may not be enough. Okay, right. So how do we access this pre-mock? Basically, it's on the ACCA website and the practice platform. Okay, so if you guys are still not familiar with all of that, type ACCA pre-mock September on Google and click on the very first link that you see. Okay, so you go down and it says access the pre-September mock on the practice platform. Okay, so that's basically where we need to go. So click on that. Okay, and then you need to, put in your ACCA ID and password. If not, you won't have access to it. So go ahead, put that in as well. Right. So here you have a set of material called assigned material and something called self-assigned material, right? So in case you haven't assigned it yet, then what you need to do is in this catalog, you have financial management, right? So click on that, click on ACCA official resources and click on practice exams, okay? So here you will have something called FM pre-September 2024 mock exam. So here I have already assigned it to myself, right? So that is why I have it as unassigned here. If you haven't assigned, you would have it as assigned. So go ahead and assign it to you, right? So once you're done with that, you will have access to that paper under self-assigned material, right? So go ahead and click that. So yeah. So it says resume because I've already opened it, right? So you can start the exam basically by clicking on that button, right? So it says here, section A. So this is basically how you should expect your exam to look like as well, okay? So it says here, section A. This section of the exam contains 15 objective test questions. Each question is worth 2 marks and is compulsory. The exam section is worth 30 marks in total. Okay, so they have mentioned everything that you need to know with regard to section A, right? So when you're ready, you can go ahead and click on next. Right. Okay, so I will, give you some time in case you need to just go through the question and then we can discuss it, right? So let me read through it first, give you some time to process it, see if you know the answer, and then we will discuss the correct answer, okay? So it says here, which one of the following options is correct relating to statements 1 and 2? Okay, so they're asking which of the following statements is correct. Statement 1, the fundamental principle of financial management for a profit company is the maximization of shareholder wealth. So they're saying the main principle, if you're a profit-driven company, is to maximize your shareholder wealth. Okay, so that's the first point. Next point is saying, according to the value for money approach, effectiveness refers to minimizing the cost of inputs for achieving the targeted level of output. So they're talking about value for money approach, fine. And they're talking about effectiveness specifically. So they're asking you what is effectiveness, okay. So statement 1, you have to decide whether it is true or false, and statement 2 also you have to decide the same, right? So go ahead, think about it and see what the correct answer should be, right? So throughout the TRG, guys, I will be using the practice platform, okay? So you will also be familiar with how you should do your workings and stuff in the real exam, right? So I do urge you also, when you're attempting the paper, to please attempt it on the practice platform itself, okay? Right, so what do you think the answer should be? Okay, you're saying option 3. Okay. Right. So profit, the first statement, right? The fundamental principle of financial management for a profit-driven company is maximization of shareholder wealth. That is kind of correct. Okay. So Jeffrey is saying option 4. So you're saying both are false. Okay. Why do you think the first one is wrong, Jeffrey? Because if you're a profit-driven company, one of your main objectives or the most important objective is to maximize your shareholders' wealth. Okay, you want to increase your profits, right? So that is correct. Fundamental principle of a profit-driven company. Then that means statement 1 is true. Statement 2 is saying, according to value for money approach, effectiveness refers to minimizing the cost of inputs for achieving the targeted level of output. Minimizing cost of input has nothing to do with effectiveness. Effectiveness is checking if the output of your organization is in line with the objectives of the company. Okay, so effectiveness is definitely nothing to do with inputs. We are comparing outputs with our objectives. So that statement is wrong. Okay, so statement 1 is true, statement 2 is false. So true and false is option 3. So you need to just click on the option and then go next for the next question. Okay. Right. Which two of the following are part of fiscal policy of a government? So they're talking about the fiscal policy. What do you think is the answer there? These ones are just there, right? So it's not correct answers. It's just by default, it's got selected. So ignore this. There's no way I can remove it. So you're saying option 2, which is 2 and 3. Okay, let's read. So fiscal policy, I'm sure you all know about it. Fiscal policy is to do with the taxation, most of the time to do with taxation and government spending, right? So first point is saying regulation of interest rates. Interest rates are to do with monetary policy. Okay, so definitely not one. Government borrowing decisions, yes, to do with government spending and borrowing, we do consider that under the fiscal policy. That's correct. Taxation policy is also definitely fiscal policy. So 2 and 3 are correct. 4, controlling money supply. Anything to do with money supply is under monetary policy, right? So the correct answers will be 2 and 3. No problem, Jeffrey. Right. Classify the following money market instruments based on their characteristics. So a repo agreement, forward rate agreements, and treasury bills. Okay. So at this point, you should be familiar with what a repo is, right? So it's a sales and repurchase. So that is basically something like you have an asset, you go and give it to the bank. I mean, you own the asset, you give it to the bank, ask them for money, and then you start paying installments for maybe the next 5 years, after which you will get the asset back to your possession. Okay. I mean, possession meaning your ownership, right? You will throughout have the asset, but the ownership changes for that period of 5 years, right? So that's a repo. Forward rate agreement, you should be knowing most of the time. Like, for example, if you are going to, say, purchase a particular currency on a future date, you go and decide today itself with the bank what the exchange rate is going to be. Okay. Treasury bills means something that the government will issue in case they need to raise funds for something. And most of the time, the interest rate that the government pays will be much lower than the normal market interest rate, because giving money to the government is considered less risky, right? So if you look at treasury bills, I know for sure it's a discount instrument. Okay, why? Because I am going to get less interest than normal, right? So that is definitely a treasury bill. Forward rate agreements, I know they are called derivatives. And if I look at the repo, it is a coupon bearing instrument, because I will have to pay a percentage of interest to the particular bank or somebody. So that interest is obviously a coupon bearing instrument, right? So that will be your answer there. Okay, so sometimes you'll get this, okay, it doesn't make sense. It says you have not viewed the entire screen, use scroll bars or open any on-screen exhibits before trying again. So if you just push this down and push it up again, you should be able to go to the next one. Right, so look at the requirement first. It's saying, calculate the expected total shareholder return for the year ended 31st December 2014 to one decimal place. Please highlight that, because if you make a mistake and give it for the wrong decimal place, that will be a problem. But most of the time, it won't let you to put in an answer other than to 1. See, if I change it, I just put it to 2, for example. It says the input does not match the expected format. Okay, so it's designed to make sure you put it to 1 dp. But for your luck, for some reason, if you're able to input something that is not 1 dp, that will be a problem. Okay. Right. So what do you think the TSR should be? So I'll take the scratch pad at this point and just put the TSR equation, right? So that is equal to, I'll open a bracket, dividend per share plus change in share price. So in your exam also, you will have to use the scratch pad most probably, right? Divided by the opening share price. So if you have all of these figures, you should be able to get your TSR. And watch the year, right? They're asking for 31st December 2014. Okay, so be careful because there is information based on 2013 and 14. So whatever you're taking has to be based on 14. Yes, Amna, I will give you a break because for me, I have to pray a little later. So maybe in about 40 minutes. Yeah, about 40 minutes. I hope that will be enough time for you. It's too early for me to give you a break now because if I give you now, then I will have to take a second break. Okay. So based on this, what do you think the TSR should be? No, there will be a break. Like I said, there will be a break in 40 minutes. Okay. So basically, you need the dividend per share for 2014, the change in the share price and the opening share price. All of those figures you need, right? Okay, so let me work through it one by one. Okay. So it's saying the dividend yield on the shares of Astute Company for the year ended 31st December 2003 was 4%. So they're giving me dividend yield. Okay, and that is for the previous year. The EPS for the year was 140 cents and the PE ratio was 6. For the year, the EPS is expected to grow by 15% and Astute expects to increase the dividend payout by 10% over the last year. There is no change expected in the PE, right? So based on what we know for 2013, right? So what do I know? Right. So if you look at the year 2013, I have something called the dividend yield. If you are not sure what to do with it, first thing and the best thing is to first write down the equation. I'm sure all of you know how to calculate dividend yield, right? So that's going to be DPS divided by the market price of a share. Okay. So now if I want to get dividend per share for 2013, I have the dividend yield, fine. If I can do something and get this MPS, market price per share, that should, that should be enough information for me to get DPS because if I get the DPS for 2013, they're telling me that the dividend payout is going to increase in 2014. So 10% I will increase that figure, right? So if you look at the other information, they're saying the EPS for the year was 140 cents and the PE ratio was 6. Okay. So if you look at EPS, right? EPS, the equation is this, no, earnings divided by number of shares in issue, right? And what is the PE ratio? Always, as a habit, get down all the equations, right? So you have the PE ratio, which is MPS divided by EPS. Okay. So now I can see that the EPS, I have the answer, right? It is 140. So let me just put it here as 140 cents. And I have the PE ratio also as 6. So if I can basically put in the figures into this equation, right? So 6 should equal to the MPS divided by EPS, which I have 140, right? So if I rearrange this equation, I can get MPS equals to 6 into 140, which will be, how much? Let me get that answer. So yeah, you can use your calculator also, right? So 6 into 140. That will be 840, right? So the market price of a share is 840 cents. Right. So 840 cents, I have the MPS. So now I can rearrange this equation because I already have dividend yield. I can rearrange and get DPS, right? So the dividend yield they told me was 4%. That should equal to DPS, which I don't have, divided by MPS, which is 840, right? So after this, if I want DPS, I will take 4%. and multiply it by 840, which will give me an answer of 33.6 cents. So this is in 2013. But that is not what I need, right? I need DPS in 2014. So what did they tell me? The DPS is going to increase, the dividend payout is going to increase by 10% from the previous year. So if I want 2014's DPS, that will basically be 33.6 into 10% increase. No, so I should multiply that by 1.10. So that should give me 36.96 cents. So that will be the DPS in 2014, which I can use in the equation. Okay. So this figure I already have. Now I need to get the opening share price and the closing share price, because when I get the share prices only, I'll be able to get the change in share price. And again, I have to divide it also by the opening share price, right? So let's see. If you look at the opening share price, we already have it here. Where was that? Here. The market price of a share was 840 cents, right? How did we get that? We took the PE ratio and we multiplied it by 140, which was the earnings per share. So opening share price we know is 840. That will be 840 cents. Okay, so I have that. Now, if I can get the closing share price, I have everything that I need, right? So if I want closing share price, I need to know both the EPS as well as the PE ratio in 2014, right? Now, they told me there is no change in the PE. So 2014's PE is fine. Okay, so EPS into the PE ratio is what I want. I already know the PE ratio is 6. Now, if I know the EPS for 2014, I have everything that I need, right? So, let's see. They're saying for the year, the EPS is expected to grow by 15%. So, what was the EPS already? It was 140. This is going to increase by 15%, right? So, let me just get the increment. 2014. So it was 140. It's going to increase by 15%. So into 1.15. So that should give me the EPS as 161 cents. Okay. So that is the EPS for 2014. So let me put it here, 161 cents multiplied by PE ratio is not going to change. It's just 6, right? So 161 into 6 will be 966 cents. So this is the closing share price. Okay, so I have everything that I need for the TSR equation. Let me copy this. Right. So TSR should equal to DPS. I think we just had it over here. 36.96. Plus the change in the share price. Final share price is 966. Initial was 840, right? So take the difference. 966 minus 840. That should be divided by the opening share price, which is 840. Okay. So put that in your calculator. Should give you the answer. You can use your own calculator also, right? No problem. You don't have to use the on-screen one. 36.96 plus 966 minus 840. Close that bracket. Come down. Divided by 840. Okay. So that will be 0.194 as a percentage. That will be 19.4, right? Because they're asking for as a percentage. You can go ahead and put 19.4 here. Okay. So it's an easy one, but it has a lot of steps because they're not giving you the figures quickly, right? They're just, beating about the bush. Like they can give you DPS directly, but no, they're giving you last year's dividend yield, making you find the last year's DPS and then increasing that by 10%. Okay, same for the price of the share also. Instead of giving you the share price, they're giving you EPS and PE, making you multiply that and then increase it by 15%, right? So they're just making you do a lot of work there. But in terms of the theory, it's a very simple theory. Okay, so that will be 19.4. Just show you the scratch pad in case you want to copy anything down. I know the scratch pad can be a little, not very user friendly, especially in this situation, right? But get used to it, right? Because we can't guarantee whether you will have a piece of paper or not at your exam, right? So we have to make do with what we have. If you have this, then you have to use it. And definitely if you're used to using Excel to answer, you have to get used to this method also, because these questions, you don't have a spreadsheet at your disposal. So you can't use the spreadsheet. Yeah. Yeah, just so you can copy it. Right. Right. So I'm just putting it here. So if you want, you can copy it, because if not, the scratch pad is kind of breaking it, right? Okay, let me know once you're done copying. Okay, great. So that will be that question, right? Let's go to the next one. Right. So it says, which of the following correctly represents a conservative working capital financing policy? Okay. So they're asking you about working capital. That's the syllabus area. They're asking you, what is the conservative working capital financing policy? Okay. Right. You're saying B. Fine. We'll see. A is saying holding a high level of current assets to minimize the risk of lack of liquidity. Okay. So they're saying keep a lot of current assets to make sure that you don't have, to make sure that you don't have a situation where you don't have liquidity. Okay. Now, guys, that is conservative only, right? Having a lot of current assets is conservative. But be careful there. That is a conservative investment policy. Okay, so if you're trying to invest, you're not going to invest in anything. You're going to keep your current assets high, not going to put the money into non-current assets, because whenever you want, you can, convert a current asset to cash quickly. But that is not a financing policy. Financing means if I want finance, where am I going to go for it? So first one, although it is conservative, it is a conservative working capital investment policy, not a conservative working capital financing policy. Okay, so don't make that mistake there. So what is conservative working capital financing policy means? We all know that taking a long-term source of finance is considered conservative. The reason for that is because when you take a long-term loan, like a 10-year loan or a 15-year loan, you don't have the need to repay that loan immediately in the near future at least, right? So that means you are having a conservative approach, because these long-term loans, it may be not flexible. You might have to keep assets as security. Maybe interest rates won't be favorable. But the only reason why we go for it is because we want to make sure that we don't have that liability to pay back quickly, right? So it's saying using long-term sources of finance to fund current assets. Now, current asset is a short-term asset. Ideally, short-term asset has to be financed by short-term sources of finance. But you are going for long-term sources. Why? Because you don't have to repay this amount immediately. So that means you are having a conservative approach. So B is the answer. Let's look at the others as well. Using long-term sources of finance, using long-term sources to finance permanent working capital and short-term finance for fluctuating working capital. This is called the matching concept. So short-term assets, you will, short-term working capital, you will fund it with short-term source of finance. Long-term working capital, you will fund it with long-term sources of finance. So that is not conservative, that is matching. Using a bank overdraft is a short-term source of finance to finance the entire working capital. So even long-term permanent working capital, you're trying to finance with short-term sources. That is aggressive. That is an aggressive working capital financing policy, right? So the answer there will be B. Right. Match the following types of commercial financing methods with their equivalent Islamic financing methods. Okay, so you just have to match the correct ones. Okay, so we have equity, debt, venture capital, and trade credit. Okay, what do you think is trade credit? Okay, murabaha. Okay, good. So I'll explain each of them, right? So murabaha is basically a situation where, let's say I want to buy an asset. You can put in your answers, Amna, while I'm explaining it. Say I want to buy an asset. I want to take a loan to buy that asset. Okay, so say I want to buy a car. So I want to take a loan to buy the car, right? Now, usually in traditional finance, what I will do is I will go to the bank, say I'm going to buy this car. Can you give me this amount? They will give it to you. Maybe for the next 5 years, you will have to pay in installments, right? But the problem is when it comes to Islamic finance, this model won't work because interest is not allowed. Okay, so now what happens? Now you can't expect the Islamic bank also to just give you the money free, no. So what happens is the bank, they buy the asset. So say for example, it's a car, the bank buys the car. and then they sell it at a higher price to you. Okay, so they sell it at a higher price to you. Say they spent 5 million to buy the car. They will sell it to you at 5.5 million and they will tell you you can pay this 5.5 million in installments. Okay, so now the bank is making a profit of 0.5 million, but not in the form of interest. It's happening in the form of trade. Okay, so that is murabaha. So what was the underlying intention? I wanted to take a loan, right? So taking a loan means we're talking about trade credit. So that's why murabaha is trade credit. Then if you look at musharaka, if you should have, gone through it. Musharaka closely comes, in line with venture capital. Okay, so it's a situation where, if you're starting a business, two parties say they put in 60% or 40% of the capital, and then how the profits and losses will be divided amongst them, right? So that will be definitely venture capital. Then if you look at Mudaraba, if you remember, it aligns closely with equity finance, okay? Where the situation is one partner puts in the money, another person puts in his expertise, and the person who puts in the money, he has to bear all the losses, whereas profits have to be shared on a pre-agreed ratio. So that will be equity finance. Sukuk is debt finance. Although we say it's debt finance, it doesn't, properly line up with debt finance because still Sukuk doesn't allow interest, right? And when it comes to traditional finance, we consider debt holders as not owners of the company. So they can't, give any input in terms of how to run the business. But Sukuk finance, if somebody gives you a sukuk, they are considered owners and they can input their thoughts about the business. Okay, so that's why debt finance, unlike the other three, although we call it debt finance, it doesn't really properly align with the traditional sources of debt finance. Okay, so that should be your answer. So if you didn't go through that area, definitely you will find yourself in a fix here. Okay, right. Okay. Under which of the following circumstances the use of existing weighted average cost of capital may not be appropriate for carrying out investment appraisal? So in which of these circumstances can't you use a WACC that you have already calculated? That's the question. What do you think is the answer? Okay. RKB is saying B. Amna is also saying B. Okay. So let me see, right? So when you're talking about using WACC, there were certain assumptions that we make, right? So some of them, or, three of them are listed here, right? So the first one is saying, the size of the new project is small in relation to the existing business of the entity. Now, actually, if the size of the project is small than your normal operations, that's one of the reasons why you can use WACC. You don't have a problem using WACC, especially we say if it is small in size, then no problem. Whereas when it is bigger in size, we have to think twice about using the WACC, right? So first one is one of the reasons you can use WACC, so that can't be an answer. B is saying the project would mean that the entity would embark on a new business area. Okay, so there's a typo there. It's supposed to be area. So what is the situation, right? Now your existing WACC, guys, it reflects your current business risk. Now, for example, you are making sunglasses. It reflects the risk that there is going to be no sun. Okay, there is the weather is going to be rainy or something like that. So your WACC is already reflecting that business risk. But let's say now you are going to go and invest in a completely different industry. You're going to go and invest in a publishing press or something. Our WACC is not reflecting the business risk of the printing industry, So it doesn't make sense to use our WACC anymore because we need to use a cost of capital that reflects business risk of that new industry. So in that case, we can't use our existing WACC. We have to go for other methods, right? So that is the answer. Let me rule out the other two as well. There won't be any change in the existing capital structure of the company, and the operating risk of the new project is not different from that of existing operations. All reasons why you can use WACC, right? So the answer there, like you guys correctly said, it is B. Okay. Which of the following scenarios would evidence a semi-strong form market efficiency? What is a semi-strong form market efficiency? What do you think? Okay. What do you think, Amna? What's a semi-strong form market? Yeah. So let's read the answers one by one and try to figure out what type of market they're talking about, right? So they're saying the first one, the asset prices reflect all past market data. So if you're going to reflect all your past market data, that means, guys, we are talking about a weak form efficient market because we are only reflecting past market data. We are not reflecting any other information, whether it be public or private. Okay, so that is a weak form market, right? Then they're saying the asset prices reflect all information, public and private. Now, if the market is reflecting everything, that is called a strong form efficient market. Okay, so that is also not semi-strong form. Semi-strong means we reflect all information, only public. We don't reflect private information. Okay, so inside information won't be reflected in the share price. Okay. Investors cannot consistently achieve above market returns by analyzing publicly available information as asset prices reflect all such information. That is true when it comes to semi-strong form efficient market. Asset price already reflects the public information. So as an investor, I can't benefit by just looking at public information because by the time I analyze the public information, share price has already changed to reflect that. Okay, so the only information that I can benefit from is private information, which they have not mentioned in this point, right? So this is something about semi-strong form efficient markets. That is why there is insider trading, like what Akib is saying. The assets are fairly priced, even including secret information. Like I said, no, secret information will not be reflected when it comes to a semi-strong form market, a semi-strong form efficient market, right? So the answer there will be C. Okay. They're asking for what is the equivalent annual cost for the 2-year replacement cycle, assuming that the cost of capital is 10% to the nearest dollar, enter a positive amount. So they're telling you all of that, right? What do you think is the equivalent annual cost? So it comes from the area called investment appraisal. Okay, one of the special calculations that we did. They're asking for a 2-year replacement cycle. What was your answer? Okay, so it says here, first lease company leases cars to various corporate users to be used for their employees. The cars are of the same specifications. The company spends regularly on the maintenance and other recurring costs. Firstly, it wants to optimize the car replacement policy to ensure that the lessee companies are provided with the best possible option. Okay. Various scenarios are developed as below. So you have the cost of the car, which is 25,000. Maintenance cost, year 1 will be 5,000, year 2 it will be 6,500, year 3 it will be 7,500. The trade-in values are estimated at the end of year 1 as 16,000, year 2 12,000 and year 3 10,000. Okay. The relevant present value factors are year 1 is going to be 0.909, year 2 0.826 and the annuity factor is 1.736, right? So then finally they're saying calculate the EAC. So EAC means how do we do this calculation? You get the total present value and you divide it with the respective annuity factor, right? So you get the total present value and you divide it with the annuity factor, right? So give me 1 minute. Amna is saying 2112. Okay. Right. So let's work through this. You're saying 14,402. Okay. So we have different answers. Let's see. Right. So equivalent annual cost, right? So they're asking for a 2-year replacement cycle, right? So I need to consider all the cash flows that happen in year 0, year 1 and year 2. So let me put the years 0, 1 and 2. Okay. Right. So in year 0, the only thing that happens is the investment. Okay. So that is the cost of the car, which was 25,000.
And like we discussed yesterday, even though the practice platform has
Space.
got many mistakes, there won't be any
Then in
mistakes.
year 1, you will have a maintenance. Okay. Maintenance. So that will be year 1's maintenance is 5,000. Okay. So since it's maintenance, I'll put that also as negative. Then in year 2, what will we have? We will again have the maintenance, which is 6,500. Plus, there will be that trade-in allowance. How much was the trade-in for year 2? It was 12,000. Okay. Right. So those are the cash flows. Let me underline it. So let me call this the cash flows. Right. So year 0, I will have 25,000. Year 1, I will have 5,000. And here it will be minus 6,500 plus 12,000, a positive 5,500. So these figures, I have to discount it. So discount factor they're telling me is 10%. So year 0 is always going to be 1. So no problem there. Year 1, they're giving it to me 0.909. And year 2, they're giving it to me 0.826. Okay. Right. So let me get the total. So let me call this the present value. So here it will be a negative 25,000. Here it will be 5,000 into 0.909. Just get the answers on my cal itself because on screen will take time. 4545 negative. And here it will be 5,500 into 0.826. So that will be 4543. Okay. So get a total present value. So that is the addition of all of these figures, right? So minus 25,000 minus 4545 plus 4543. That will be a negative 25,002. Okay. So this figure, if I divide it with the respective annuity factor, I will get the effective annual cost, right? So I will divide it by the annuity factor. I think they already gave it to me.
It's
Let me see
1.736.
if I close this 1.736. Yeah, okay. So 25,000, you can ignore the negative sign, right? So 25,002 divided by 1.736, that'll be 14,402.
The
So
thing
they
is,
said enter a positive value to the nearest dollar. So that will be my answer, 14,402.
I got this answer, but they put it wrong.
Thanks, Amna. Okay. So I can go ahead and put my answer here, right? So that's going to be the effective annual cost, right? You can take it down. I think both of you got the answer, right? So that should be fine. Let's go to the next one. The variable cost of a toy battery produced by Alex Company is $60. Operating profit is 15% of the selling price of $100. They're asking for operational gearing of Alex Company up to 2 decimal points. Okay. Just keep this in mind. Like I said, you won't be able to put any other answer, right? See, if I put 3.658 and I click next, I will get this input does not match, right? So most you won't be in a position to make that mistake, but still, be careful. So do you have an answer for operational gearing? Based on what you have in the question, you should decide what is the equation to use. Okay. So I have variable cost. I have selling price. When I see selling price and variable cost, the first thing that strikes is contribution. Okay. So I know that there is an equation for operational gearing, which goes as the contribution divided by the operating profit. Okay. So I have contribution. They're telling me operating profit is 15% of $100. So I can use that to get the operational gearing figure. Akib, both are correct. Okay. But based on this information, you don't have anything to do with the fixed cost. Okay. So I don't have a way to calculate the fixed cost. So in this case, I will use contribution divided by operating profit. If they gave me something to do with fixed cost, variable cost, I will use the other equation. Okay. So operational gearing, that will be the contribution divided by the operating profits. Right? So they give me the selling price and the variable cost. So if I deduct the two, it will give me contribution, right? So let me get that. 100 minus 60, which is 40. So 40 divided by the operating profit. So I think they gave me how to calculate that as well. How much is that? 15% of selling price, right? So that will be $15. So 40 divided by 15. So that should give me 2.67. Right? So that is that. Okay. Yes, Akib. I can see all of you have become very religious just before the exam. Even Amna asked me some time to pray, right? So I'll finish off section A and I will give you time to pray. So just 5 more questions and you can go. How are you, Amna? Okay, with the syllabus, everything is fine. I think I didn't see you the last few classes. I hope you have caught up on the recordings and everything is okay, right? So if you have problems, please reach out to me. Right. So what does it say here? What is the ex-dividend market price of Epsilon company's share? What were your answers? So it's a good question. In terms of the question, it's a good one. Okay, if you went to SL on holiday for 2 weeks, you could have visited us. You missed 3 classes. Okay, so did you catch up on those recordings? Okay, great. So yeah, hope that doesn't put things off, right? So hope both of you and everybody who's watching the videos, now is the time you should actually start peaking. So this should be the point where you spend the most number of hours. This should be the time where you're doing the most number of questions and you're uploading the most amount of information to your head, right? So at this point, you shouldn't slack off. Okay, now you only have 2 weeks. Now is the time you should be at your peak. Okay. Right. Actually, the others, after this question, the others are also a lot of lengthy calculations. So we'll do this and take a break. Okay. So we'll have more time. Then a lot of people feel like that, Akib, but some people are very comfortable with accounting based, like double entries and, making statements and stuff. But yes, you do understand that that is a little boring at one point. So that's why it's up to you to decide what your career will be, right? Because if you like finance, if you like this area, then you don't have to be the traditional accountant. That is the advantage ACCA is giving you. They're giving you all possible options that you have, right? So if this is what you want to do, then you are looking at something like analysis, right? So you should look into areas like business analysis. You'll be happy, right? So it's saying the dividend paid by Epsilon company for the year 2010 was 30 cents, and for 2013 it paid out 35 cents. So remember it this way, 2010 and 2013 is 3 years apart, okay? Epsilon is likely to maintain the same growth in the dividend payout as before. Cost of equity is there. The growth rate should be rounded off to 1 decimal point. Okay, so I'll just highlight that because that's not the answer, but I will use that answer. Okay, so they're asking me what's the ex-dividend market price of an Epsilon company share. So what are the information I have here, right? I have 2 dividends. Okay, so I have 2 dividends. What else do they have? What else? I have the cost of equity. Okay, so I have 2 dividends. I have the cost of equity and they are asking me for a market price. Okay, now directly when I look at it, it might not strike me, right? But when I find out, okay, there is a year 2010 and a 2013 dividend, at least one thing should strike, and that is I have to use extrapolating past dividend method to get growth. And I have 2 dividends like this, usually that's the method, right? So once I realize that I need the growth, next thing I should realize is I have G and I have KE. So if you have KE, G and a dividend, then obviously the dividend valuation model itself is enough for you to get the market price per share, right? So let's go ahead and, do equations one by one, right? So we know that this is the equation for the dividend valuation model. We say P naught equals to D naught times, put it in square brackets, D naught times 1 plus G, close the bracket, over KE minus G, right? So I know that this is the equation for the dividend valuation model. So I know the D naught, the current year's dividend. I know KE. If I have G, I will be able to get P naught, which is the ex-dip market price, right? So let's figure out how to get growth. I don't have Gordon's growth information. So the only option is to extrapolate the past dividends. Okay. So G should equal to, there is an equation, right? So I'll just put it here, D naught, which is the current year's dividend, divided by the dividend n years ago to the power 1 over n minus 1. I know it's not proper, right? But I'll show you how to put it in the cal. I know that you don't write the equation like this. In Scratchpad, we don't have an option. We can't write it out, no. So we have to type it like this only. Oh, by the way, examiner can't see the Scratchpad. Okay, so whatever you have over here, they won't be able to see it. So especially in section C, don't leave any of your calculations here. Transfer everything to the spreadsheet. Okay. Right, so G should equal to D naught, which is the current year's dividend. The latest that we have is 35 cents. So 2013, we are considering that the current year. So 35 divided by old dividend, that is 30. How many years ago was this? 2013 means 2010 is 3 years ago. So to the power 1 over 3 minus 1. Okay, so I'll get the growth rate. So how I would put this is, I will open a bracket, put this 35, come down 30, close the bracket. I'm also not familiar with the powers here. Okay, right. So you don't have to always, use the on-screen cal, right? You can use your own cal. That's not an issue. Okay, that happened. I'm just showing you because, in case you happen to need to use this, right? Come to the side. There's no way for me to go back, is it? Yeah, okay. So I'll just try once more, okay? So I'll come here, close this bracket to the power 1 over 3. So I'll open another fraction, 3, and then come here, minus 1. So that should give me the growth rate. So I'm talking about 0.052. So as a percentage, it is 5.27. They told me to round it off to 1 decimal point. So I'll take it as 5.3%. Okay, so growth rate is 5.3%. Again, you're not compelled to use this cal, right? You can use your cal and get your answers, not an issue. So we have the growth rate, we have D naught, we have KE, so we can get P naught easily. So that will be D naught times 1 plus G. So D naught we know is 35 times 1 plus growth rate is 5.3%. Okay. Divided by KE, which is 11% minus 5.3%, right? So that should give you P naught. You can put it in the cal. Okay. Right, so I'll put it on my cal instead of wasting time. So 35 into 1 plus 5.3% divided by 11 minus 5.3%. Okay. Right. So that should give me an answer of $6.47. The answer there will be D. Okay, so just for completion, I'll show you how you put that in the cal, right? I don't want to use this one. It's annoying me. So 35 times 1 plus 5.3, 11% minus 5.3%. Okay, so that will be, this is giving it to you in cents. Okay, so 646 cents. So you need to give that in dollars. So why is it giving it to you in cents? Because 35 is a cents figure. Okay, so that's why I wanted to show you that. So 646 cents means divide that by 100. So that should give you your answer in dollars, 6.465. So to 2 decimal places, 6.47. Okay. Okay. Right. So let's quickly take a break. It's 7:10, right? So come back in about 15 minutes time. 7:25, come back at 7:30 and we will finish off the remainder, right? As much as possible, we finish off the paper. Whatever we have remaining, I will do it next week. Okay, so I'm hoping to finish off at least 2 to 3 questions of section B, the MTQs. Okay, so take this down and then take your break and then come back at 7:30, right? So 20 minutes, come back in 20 minutes time. 7:30. So let's start. Saying here, what would be the maximum NPV that FTSE could achieve by optimizing its investment within the limits of 550,000? Okay. So let me read the question. It's saying, FTSE company has 5 possible capital investments for which the financial details are given below. Okay. So we have project A, where we will have an investment of 250,000 and an NPV of 6,500. B investment is 160,000 and the NPV is 6,000. M, the investment is 175, 3,500, N 135 and the NPV is negative. So straight away this N will completely be out, right? Because we would not carry out a project with a negative NPV. So let me just highlight this to show that it's out. Q 108,000 and the NPV is 1575. The company has access only to 550,000 of capital expenditure. Projects A and B are mutually exclusive. All the projects are divisible. Okay. Right. So the first thing is, since all the projects are divisible, other than N, we need to get the profitability index of all of these projects. Okay. So let me get the scratch pad. So there was A, B, M, and Q, right? So we don't need N. So you have the investment and you have the NPV, right? Yeah, you can't do A and B together, mutually exclusive. So you can't do it, right? So investment here is 250,000. NPV is 6,500. So B is 160,000 and 6,000. M 175,000. 3,500. This is 108,000. And 1575. Okay. Right. So now let's get the profitability index. Okay. So you should be knowing that profitability index is basically your NPV divided by the investment. Okay. So I'll get it for each one. 6,500 divided by 250,000. 0.026. Then here you have 6,000 divided by 160,000. 0.0375. Okay. Then you have here 3,500 divided by 175,000, which is 0.02. And here 1575 divided by 108,000, which is 0.0146. Okay. So now let me rank everything. So the highest that I have is 0.0375. So this will be 1. Then I have 0.026. So that will be 2. Then I have this, which is 3. Then finally I have this, which is 4. Okay. So what are they telling me? They're telling me that something was mutually exclusive, right? I think it was A and B are mutually exclusive. So that means if you do A, you can't do B. If you do B, you can't do A, right? So which one is the first rank? That is B. So we will opt to do B first, right? Okay. So let's get the optimal investment schedule. So first we will do B. And we have a maximum of 550,000 that we can spend. That's the maximum that we have. So first we will do B. We'll see how much that will cost us investment wise. And how much we will earn NPV wise. We want the maximum NPV, right? So B will cost us. So we have in hand 550,000. So B, the investment is 160,000. So we will spend the entire 160,000. and we will earn an NPV of 6,000. Okay, so that will give us a remainder of 550 minus 160, which is 390. So we will have 390,000 in hand. Then there is the next rank, which is number 2, but we can't do that, right? Because it is mutually exclusive. So we will move on to M. So we have M, which the investment was 175. We have 175, so we will use the entire 175 and earn 3,500. Okay. So 390 minus 175, we will have 215 in hand. So then finally there is Q, which we can do for 108,000. Okay, which will give me 1575. So I will have cash remaining. So that's 215,000 minus 108,000, which is 107,000. Here, $11,075. Okay. So the maximum NPV you can earn is 11,075. Okay, so this is the optimal investment schedule. Why did you use A?
Since we cannot use
Because the
A,
ranking wise, B is only coming first, no, Akib. Right? So if B is coming first, you will have to do B first because that is a more profitable project. If you do B, then you won't be able to do A because they're mutually exclusive. So if you do it with A, it's wrong. Did you get the answer?
yes, I got the answer as 11,075. And another thing is with this, we can't just start with A also, no? We have to go according to rank.
Yeah.
We can't just start with A also, right?
Doesn't matter because the investment is higher for A. You're putting in 250 and getting an NPV of 6,500. Here in B, you're putting 160,000 and getting an NPV of 6,000. So you're getting obviously more NPV for B. Okay, so it's not based on NPV, it's based on the PI that you rank. Got it? Rankings are always done based on the PI, not based on any other thing. Because in this case, yeah, NPV is higher, but it has taken almost 100,000 more to get that 500 extra. Right? Okay. Is that clear? Everybody got it right? But what do you mean more indivisible projects? You mean if a project is indivisible? Yeah, if it is indivisible, then you can't use PI. If it is divisible, you can. Mutually exclusive being divisible also you can. Indivisible is trial and error. Okay, so that is obvious there. Here they're telling you all the projects are divisible. Okay. Got it right? Any questions? Right. So then based on trial and error, yeah, based on trial and error, yes, you have to go for the higher NPV. That is correct. Wait, let me check. So even if I do it your way, if I'm going to do it based on trial and error, I will take 6,500 and 3,500 and I will take 1,575 and yeah, you will get 500 more. Yes, that is of course correct. Okay, so let's see what they are saying. because I think there was a small issue with this question. Let me see what they're saying, okay? One second.
What are debrief videos?
This issue has happened because both the rank 1 and 2 has become this one, the high NPV. Debrief videos, Akib, is not all the questions, right? So section A, I think very few questions, but section C, if I'm not mistaken, they work out the question for you. So you can have a look at that, right? So let me just check what it says here. This is pre-March. Okay, I think I need to put an answer for everything and then get an answer. Let me check. Yeah, so if you want to mark it, you have to basically do this, right? So our answer is 11,075 based on using the PI ratios. Did they mention to use PI anywhere? They didn't mention, right? So let's just turn in all these answers. I'm just putting something, right? These are wrong, okay? I'm just putting it. So I want to see the answer that they're saying. For that, the only option I have is to do this. Yes, you have to use PI. That's what. But like he's saying, I mean, somebody mentioned, right, that if you use trial and error, then the other option to do A instead of B is the better option. So I just want to check if the answers are considering PI or whether they are considering trial and error, because logically trial and error wise will work. We can't say trial and error won't work. No, it will work. But we also know that if it is divisible, you have to use PI. So let's just check that out to be on the safe side. So bear with me. They don't, let you get the answers without attempting all the questions. I hope it comes through. You can check the debrief video, but yeah, that will take a long time because section A knows. You guys can check it and see what they are saying. But I just want to see what their answer is, because based on what I know that they will only use PI. They wouldn't use a trial and error, right? You can check the debrief, but section A, very few questions only they do. So I can't even be sure if they are doing this particular question, right? So you can go through that in your free time. Because they have a marking scheme that they release as well as the debrief video as well. So both, right? Right. So I'll end this exam. So now I should be able to mark it. Yes, I know. This platform is a little annoying. So you can say self-mark here. Which question number was that? That was 12, right? Let me go to 12. Okay, see, they put 11,075. They haven't put 11,575, although yes, according to trial and error, you can. they are saying the decision will be taken on the basis of the profitability index because it is divisible. The project N will be excluded because it has a negative NPV. So the PIs, they're giving you for B, A, M, Q. They're saying A and B are mutually exclusive. So you will choose B because the PI is higher. And total NPV will be 11,075. Okay. I'll tell you why actually. There's a reason for that, right? Now let me go back to the question to see. September, right here. There's a reason for that. If you see in that scratch pad, when I gave you the, the answer, there was a particular amount that was remaining, right? So in this case, there was a remainder. But sometimes there will come a position where you will have limited finance and you will have to divide the project. In that case, when you're doing the division, if you don't use this PI method, you will end up not getting the optimal schedule. That's the reason why when it is divisible, you have to make sure that you use the PI method, right? So I just wanted to double check with the marking scheme. So you also saw it. They have 11,075 as an answer, right? So we were on question number 12. Right, so this will be 11,075. So now let's move on. Question number 13. Okay. Right. So it says here, Oriental Company, a company based in Singapore, has dispatched goods worth Singapore dollars 1.5 million to its US customer, Edge Company. The payment is due in 120 days. The Singapore dollar is expected to strengthen in 4 months' time against the US dollar. For each company, select what the impact would be on the date of payment, assuming that none of them plan to hedge the currency risk. What do you think the problem is? Do you think Oriental will have a problem? Or do you think Edge will have a problem? Or will they both have a foreign exchange problem? So situation is this. There is a company, Oriental, based in Singapore. And they have sold something. Okay, they have sold something and they have quoted in Singapore dollars. So they will receive in Singapore dollars. And then there is another company called Edge Company. They will have to pay in Singapore dollars. And they are based in US. Okay, so obviously their currency will be US dollars. Edge will have a problem. Okay. So what about Oriental? Will they have a problem? Okay, now be careful here. Okay, there is a tendency to make this mistake because it is Singapore dollars now. So if you by chance don't read this S, you might feel like Oriental is getting 1.5 million US dollars because we're used to the dollar sign. Usually dollar means US dollar, right? But here they are saying a company based in Singapore is going to get 1.5 million Singapore dollars in 4 months time means 4 months, 30, 60, 90, yeah, 4 months, right? So that is not going to impact that company. Now, if I am a Sri Lankan, I am going to get 50 million Sri Lankan rupees. Whether I get it today or whether I get it in 4 months' time, 50 million rupees will remain 50 million rupees, right? So there is no foreign exchange problem for me. So here for Oriental, no effect. But the problem happens with Edge because what is happening? The Singapore dollar is strengthening in 4 months' time. So they are US based, right? So in 4 months time, they will have to buy Singapore dollars, which if the Singapore dollars become strengthened, it becomes more, you need more US dollars to buy Singapore dollars. So in 4 months time, you will have to spend more US dollars than what you would spend today. So ultimately, you would make a foreign exchange loss. Okay, so whichever currency, if I'm going to pay in that currency and that currency is going to strengthen, that is always bad for me. Right? So for H, it will be a foreign exchange loss. Right? Yeah. What's the expected market value of the bond to the nearest dollar? Okay, so this is to do with valuation of debt. Was this the question you spoke about yesterday, Akib?
No, it was in section C.
103,103. Okay, $103, Akib is saying. Okay, yours was in section C. Okay. Right. So it's saying here, Melody Company had issued $100 redeemable bonds some years ago on which interest at 7% is payable. The interest for the current year has just been paid. These bonds are due for redemption in 2 years' time at a premium of 10% on the nominal value. Investors in the similar bonds require a yield of 10% per year. So we have the cost of debt. Similar bonds are going to be 10% yield, right? So we have the cost of debt as well. The discount factors are as follows. The present value factor at 7% and 10% is given to you. Will they give? They might give, they might not give. If they don't give, you still have the formula sheet, right? So you can always access it. Okay, so it's up to them whether or not they will give it. It's up to them. What is the expected market value of the bond to the nearest dollar, right? So now these are redeemable bonds. If you want to get market value, you have to do something like an IRR calculation, not IRR, because if you're calculating IRR, you get cost of debt KD, which in this case, they have already given it to me, right? So I don't have to do the exact IRR calculation, but something along those lines have to be done, okay? So let's get the scratch pad. So what do we have in this situation, right? So let's just put the headings first. Years. Yes, and even if not Akib, you don't have to worry about tax here because they haven't given you the tax rate. Okay, so you don't have to worry about it. If it is the post tax, then they will mention it very clearly. Okay, so you have years, then you have the cash flows. Okay, so let me first figure out what we have, right? So in year naught, obviously we will pay the market value, which we don't have. Then in year one, there will be an interest payment. Actually, in year one and year two, there will be an interest payment. I'll tell you why I am going to write it this way, right? So usually we can say year 1 to 2 interest payment, it's an annuity and I can put the interest over here. But here the problem is they're giving me only present value factors. They're not giving me annuity factors, right? So that is why I don't want to put it like this. How I will type it is in year 1, there'll be an interest. And again in year 2, there will be an interest plus a redemption. A redemption plus interest, both will be there. Okay, because year 2 cash flows means I can use the present value factor that I have there. No, I don't need an annuity factor, right? So what was the interest they're saying? $100 redeemable bonds, interest is 7% means obviously the interest payment will be 7% into $100, right? Which will be 7. These are dollars. And redemption, they're telling me it's at a premium of 10% on the nominal value. So that means that will be 110 plus the interest for that particular year will be 7. So totally, actually, it will become 117. So I'll just put that as well. So now they're telling me that investors with similar bonds require a yield of 10%. So usually the discount factor will be at the cost of debt, which they're already telling me was 10%. So I need to use the 10% figures, right? So year 1, 10% will be 0.909. It's already there in the question. Year 2, it will be 0.826. Right, so now let me multiply it and get the present values. So 7 into 0.909 will be 6.363. And 117 into 0.826 will be 96.642. Okay, so I can take a total then. That will be 103. Okay, so that is the market value. We have it here, 103. Okay, simple. You can take it down if you haven't. Right. Let's move on to the next one. The last one in section A, right? So in which of the following statements are correct with regard to the valuation of debt? So when you're trying to value debt, what do you have to consider, right? So the first one is saying, when determining the market value of redeemable debt, that's what we were doing now, the present value of the future interest and redemption is calculated using coupon rate as the discount factor. I hope it's there here. We did not use the coupon rate as the discount factor. We used the required rate of return by investors. That was the discount factor. If we use coupon rate, you would have used 7% here, right? So that is definitely wrong. When you're doing the discounting, you use the required rate of return, cost of debt, right? So that will be completely wrong. So can't be one. The floor value of convertible debt equals to the market value with the conversion option. That's wrong. Market value without conversion option. Okay, so if you want to know the market value with the redemption option, then we call that the flow value. Okay, so it is not the conversion option. So basically, what I'm trying to say is, this is convertible debt. If this was redemption and not conversion, then the market value that you get is called the flow value. If you use the conversion option, then you actually get the market value of that particular convertible, right? So that is also wrong. Conversion premium of a convertible debt is the difference between the market value and the current conversion value. That is correct. And the conversion value of a convertible debt equals to the number of shares on conversion multiplied by the likely share price on the date of conversion. That is only the conversion value. So that is also correct, right? So that will be 3 and 4, which is B. Actually, you don't even need to read the 3 and 4, right? Because we have already ruled out 1 and 2. So we obviously know the answer has to be 3 and 4 there. Okay. Right. So let's move on to section B. It says this section of the exam contains 3 OT cases. Each OT case contains a scenario which relates to 5 OT questions. Okay. Each question is worth 2 marks and is compulsory. The exam section is worth 30 marks in total. Okay. Right. So let me click on next. Right. So we have a scenario here. It's actually compared to the usual scenario, it's a little long. Okay. So fine. It's always a good idea, guys, to read through the requirements first so you know what to look for in this particular question, right? So it's saying, why is the valuation of equity of a company necessary? Okay, so that's seeming, looks like a general question. It has nothing to do with this particular company. Then look at the next one. They're asking for the asset value of small company using the net realizable value basis. Okay. You calculate the market value using the PE ratio method of the ordinary shares of medium company. Okay. Which of the following correctly represents the value of alpha startup company using the discounted cash flow basis? So basically everything to do with business valuations are here. We had asset-based valuation, there's a PE ratio-based valuation and a discounted cash flow-based valuation. All the 3 types of valuation is there. Which of the following is the correct way to calculate market capitalization? So I can see the first and the 5th question is generic. Okay, even if I don't read this question, I will be able to answer it. 2, 3, 4 are specific to this particular scenario. Okay, so now let's read through. When you're going back, make sure you come to the correct question, right? Don't miss a question or anything. You can use this navigator, right? So if you have any incomplete questions, it will tell you, right? So let me read. We're talking about a company called Ernst Company, a well-diversified company that has successfully grown over the years by adopting a strategy of inorganic growth. Inorganic growth means you're basically acquiring other companies. Organic means you are spending on the business, you're spending on marketing and all of that, and you're somehow making the thing happen, right? Whereas inorganic means you're buying established businesses, small businesses. So what your main strategy is to put money and buy, right? 3 acquisition opportunities have been identified as follows, right? So we have a company called small company. I'll just highlight small company because there was a question to do with small company, right? So I'll highlight it so I know where to look at next time. Manufactures parts required for automobiles. The extract from its statement of financial position on 31st March 2014 is given below. So I have the non-current assets, current assets, that is inventory, receivables. Okay. The non-current assets include goodwill of 250,000. Fine. The other non-current assets are considered worth 80% of their book values. Fine. Inventory is net of an obsolescence provision of 40,000. So this 280 includes a provision of 40,000. Going forward, obsolescence should be brought down to 20,000. That means currently if this is 280, we have deducted 40,000. Now we have to deduct only 20,000. So add back the 40 and deduct 20. The receivables are expected to yield 90% of their book value. Fine. So that is about small. Okay, so just keep in mind, right? This part of the question is about small company. Medium company is an unlisted company engaged in manufacturing of parts for aerospace industry. It earned profit after tax of 850,000 during the year just ended. It has 1 million ordinary shares with a nominal value of $1 each in the issue. A listed company engaged in the same sector has posted an EPS of 1.2 and a PE ratio of 10. Okay. Most probably, this is only the question where we have to look at the PE ratio and the market value based on that. Alpha startup company is engaged in software development. Its new software is fast becoming popular and the market seems to be promising. The cash flow projections for the coming years are given below. So I have year 1 to 4 and the cash flow predictions. Post year 4, the cash flows are expected to rise by 2% perpetually. The cost of capital is 11%. Okay, so I have all the information that I need in this question. So let's read the first requirement. Why is the valuation of equity of a company necessary? Meaning, why should we value our shares? Okay. So number one is saying the company is planning to raise equity finance in the primary market. So you want to issue new shares means you have to know the value of your share, right? So that is obviously correct. So one of the reasons why we want a valuation for equity is if you want to raise new equity finance. Fine. The company wants to establish the terms and conditions for mergers and acquisitions. So somebody is going to come and buy my company means I should know first of all how much I am worth. If I don't have that value, then I won't know how much to accept. So 2 is also correct. Company has the primary focus on mission-driven activities and no profit motive. So the moment you don't have a profit motive, guys, you don't have to worry about how much your equity is worth and all of that. Because at the end of the day, even if you're making a loss, you're happy, you're fine, right? So third one doesn't really make sense, right? So the answer there will be 1 and 2. Okay, right. So then they're saying calculate the asset value of small company using the net realizable value basis to the nearest of 1,000. So you can see the answer also they're giving the 3 zeros to make sure you don't make a mistake. Okay. So small company means we're only talking about this paragraph. Okay. So let me just highlight it. So what are they saying? We manufacture parts required for automobiles and we have all our numbers. They're asking us to get the asset value using the NRV basis, right? So let me get out this scratch pad. Right. So first, let's get the net realizable value for non-current assets. So currently it is 1,275. Okay. But they're saying it includes a goodwill. This is 1,275 in thousands. Okay. So careful. Non-current assets include a goodwill of 250,000. Now, if you're using net realizable value approach, you should know that you can't include goodwill because goodwill is a figure that you can't, accurately, you can't accurately say no, that 250 is the correct number. For different people, the calculation might give different values, right? So 250 can't be included in non-current assets. So you will deduct it. I'll put it as 250 because I'm doing this in thousands, okay? The other non-current assets are considered worth 80% of their book value. So the book value is going to be 1,275 minus 250. So that is 1,025. Now this is book value. If I want NRV, they're saying that is going to be 80%, right? So into 80%. So that should be 820. So the net realizable value for non-current assets is 820. Correct. You can't consider intangible assets, right? Only it has to be tangible assets that can be considered when it comes to asset-based valuations. Fine. So you have current assets. Under that, we have inventory. How much was that inventory? It was 280, but they had some story there also. Inventory is net of an obsolescence provision of 40,000, meaning I have already deducted 40,000. Let me add that back because they're telling me to change that somehow. They're saying going forward, the obsolescence should be brought down to 20. So earlier I deducted 40. So to remove that impact, I added back 40. But after this, going forward, I have to give a provision of 20. So I will do that. So 280 plus 40 minus 20 is basically 300. Right? So that is inventory. Then receivables. How much do I have? I have 520 and they're saying it should be 90% of that. So that will be 460. Right, so I can add up all of this. So that is 820 plus 300 plus 468. So net realizable value will be 1588. Okay, so it's already in thousands. So I can just put that figure here. Okay. You can take it down if you haven't. Right. So I have done everything that they asked me to do with regard to small. Okay, so now next I think they will ask about medium. Right. Calculate the market value using the price earnings ratio method of the ordinary shares of medium company to the nearest of 2 decimal places. So medium company means this information has to be used. What do you think is the answer there? They're asking you market value using price earnings ratio method of the ordinary share of medium company. So meaning one ordinary share. Okay, so they're asking me market value of one ordinary share, right? So when you're using the earnings-based methods, PE ratio is one of them. So the market value of the company, okay, so don't make this mistake. Market value of the company equals to earnings into the PE ratio. Okay, so if they were asking us for market value of the company, then what we will do is we know that the earnings is 850,000. No, that we will multiply it with the PE ratio of 10. Okay, but here they are not asking me for the market value of the company. They are asking me for the market price of one share. So for that, it's not going to be earnings into PE ratio. It's the earnings per share into PE ratio. We usually don't write the equation like this, but you have to use your common sense in this case. Okay. So if you're going to get EPS, that will be your earnings divided by the number of shares in issue. So earnings we already have, it was 850,000. Divide that by the number of shares. I think we had 1 million ordinary shares, right? Yeah. So the EPS for that particular company is 0.85. Okay. Then they are telling me a listed company engaged in the same sector has a EPS of 1.2 and PE ratio of 10. Obviously, I can't take their EPS. I have to take my EPS and multiply it with the PE ratio. So 0.85 multiplied by 10. So like someone mentioned, 8.5 per share. So they're saying nearest of 2 decimal places. So 8.50. Yes, they have given you that EPS to confuse you because you might feel, okay, if it is the same sector, I can use the EPS, but wrong, right? Earnings is different for company to company. So you have to use your own earnings to get the market value. Take it down if you haven't. Right. So finally, let me go to the last one. Which of the following correctly represents the value of startup company using the discounted cash flow basis, right? So alpha startup means you have to use the last paragraph's information. What do you think is the answer there? Discounted cash flow means you have to do something like a NPV, right? Right. So let me read through it. What is it saying? ACCA is saying D. So that is what? 2367.44. Okay. Let's see. Okay. Let's see. Okay. So we have the scratch pad. We want the discounted cash flow basis, right? So what we will do is we will have the years over here. So in year 1, something is happening. Year 2, something else. Year 3, year 4, something else is happening. Fine. So then we have the cash flows. In year 1, we have 130. Year 2, we have 180, 210, and 240. Now let me just read what they're saying. Alpha startup company is engaged in software development. Its new software is fast becoming popular and the market seems to be promising. The cash flow projections for the coming years are given. Fine. Post year 4, the cash flows are expected to rise by 2% perpetually. The cost of capital is estimated at 11%. Okay. Now this perpetually story, they're saying from year 4 to perpetuity. Okay, so I'll just put it like that. This 240 is going to keep on increasing by 2%. Okay. Now, usually this is kind of a growing cash flow, right? So you have to use an equation similar to the dividend valuation model. Okay. So I'll show you how this is done. So just think of a dividend valuation model, right? So usually you will have the normal dividend. In this case, the normal earning, which is 240. That is growing by how many percent? 2%. So into 1.02. Okay. That we divide usually by KE minus the growth rate, right? So same thing you'll do here as well. The cost of capital, 11%, minus the growth rate, which in this case was 2%. That will give you the cash flow that you're looking at. That cash flow, you will have to discount it. Okay. So I always tell you, right, in your paper, there will be one question that will be something you haven't seen before. This is the example in this paper. Okay. So again, at your exam, if you don't know about this, don't worry because this is still just 2 marks, right? So now let's say you didn't know about this. How will you tackle this situation? you do the answer for the cash flows for year 1 to year 4. See whatever the answer you're getting. Okay, so I'll do that now. Okay, so cash flows, discount factor at 11%. They had given me the rates. Oh, no, they didn't give me the rates, right? So let me take the formula sheet. 11%, right? So present value table. Let me copy it down. 0.901. See properly. So I have the numbers, right? So I'll just put it here. 0.901, then I had 0.812. Then I have 0.731. And then finally, it is 0.659, right? So till this point, everybody knows, right? So I'll get the present value also at 11%. Okay. So that will be 130 into 0.901, which is 117.13. 146.16. 153.51. Okay, and then here it will be 158.16. Okay, now just these figures, right? Only the ones that I've got here, that is year 1 to year 4, without considering the perpetuity, that will be the answer. I'll give it to you: 117.13 plus 146.16 plus 153.51 plus 158.16, right? So that alone will give you 575,000. Okay. So you know that they're talking about a perpetuity here now. So you have 575, but I always tell you this, right? When you have answers that are similar, you can see B, C, and D are similar. Chances are that the answer will be from them, right? So if you didn't know about this perpetuity, the least you can guess here is it can't be 575 because there was another cash flow happening, right? So definitely it has to be one of these three. If you're not getting the answer, just guess up one of the three and go on. So it is a calculated guess because you're choosing one out of three. If you choose the correct thing, you're right, right? But how do you get the answer in this question, right? So let me show you that. So this 240 is growing by 2% now. So what we do is we try to get the cash flow using something similar to the DVM. Okay, so this is the equation. 240 into 1 plus G. So 240 into 1.02 divided by the cost of capital, which is 11% minus 2%, right? So when you put that in your cal, you will get the cash flow as 2,720. Okay. Now this you will discount it at the 4-year discount factor, which we already have over here, which is 0.659. So how much is that? 1792.48, right? So now all of these answers, you will have to add it up, right? So that will give me the total value. So that will be 117 point, let's see if I have that answer. Yeah, so the first four is 574.96 plus 1792.48. So the answer will be 2367.44, right? So when you round this, we were doing everything in thousands. So if you're going to give it as a full figure, it will be 2,367,440. So the closest is 2,367,000. Okay. So you can take it down. Don't be put off by something like this. Okay. If you can do all the questions and this question you couldn't do, it's fine. Okay, everybody doesn't expect you to know 100% of the paper, no. Okay, especially, you know what will happen if you do a question like this 2-3 days before the exam, you'll get demotivated. Oh my God, I didn't know this, right? Don't worry. This is just one question out of so many questions and it's only worth 2 marks. They never give a lot of marks on something based like this, right? So don't worry too much about it. Right. So hope you have that taken down. Let's look at the next one. Which of the following is the correct way to calculate market capitalization? So market capitalization, I know how to calculate the market price of the share into the number of shares in issue. Simple, right? So first one is saying number of ordinary shares in issue multiplied by the current market price per share. That is only market capitalization. I can go ahead and select it, but let's go through the others also. The weighted average number of ordinary shares multiplied by the current market price per share. We don't take an average of the shares. We on the date that you're doing the calculation, you take the number of shares you have in issue, multiply it with that day's market price. That's it. We don't try to take averages or anything when it comes to market capitalization. So second one is wrong. Number of ordinary shares in issue, that's fine. Multiplied by the average market price. No, we don't take averages when it comes to market capitalization. Here they're saying number of ordinary shares in issue multiplied by the current market price per share plus the market value of debt. No. Market capitalization is just the equity value, right? So answer there will be A. Right. So I think we will have time to finish off the other MTQ as well. So let's leave the third MTQ plus the two questions, right? The big questions for the next TRG, right? Okay. Now this is a much shorter question to do with risk management, I believe, because I can see euros and all that. Read through it. First, let's go through all the questions, right? So from 21 to 25, we have to go through. So first is saying, considering the opinion of the junior accountant, classify whether it's true or false, something to do with interest rate parity and something to do with the dollar and euro exchange rate. Fine. Then they're asking what are the risks that you would face. They're given all the types of risk. 4-month exchange rate between euros and dollars, assuming that the interest rate parity holds good. Okay, so they're asking for a forward rate there. Then they're saying which of the following would be a good hedging tool. Fine. Finally, something to do with calculate the gain or loss if they hedge it using a forward rate. Okay, so some calculation you have to do, right? So those are the 5 questions, right? So let me go to the first one. Question 21, right? Okay, so go through the question. I'll give you a minute and then we can check which one is correct. So you can go through it and even give me the answer and then I will read the question. Okay, so let me read through. It's saying McGregor Company is based out of the country of Zealand, whose currency is the dollar. The company has supplied goods to its customer in the country of Douro, based in Europe, having its currency as euros. Okay. McGregor is due to receive 2.1 million euros in 4 months' time. Current spot rate is 1.3985 euros to the dollar. The short-term interest rates in Zealand and Euro are 1.9 per annum and 3.75 per annum respectively. The junior accountant is of the opinion that McGregor will benefit as the euro is likely to depreciate in 4 years' time. So that is only this question, right? Something to do with what he's saying. McGregor is considering raising funds to part finance its new project by obtaining a debt from a well-known bank at a variable rate of interest in 3 months' time for 12 months. The bank has quoted the interest rate of base rate plus 0.5%. The company, however, is worried that the base rate may go up. Finance director wants to hedge that risk. Okay, so 2 risks are there. The first paragraph is talking about a forex risk. The other paragraph is talking about an interest rate risk. Okay. Considering the opinion of the junior accountant, classify each of the following statements as true or false. So what is he saying? He's saying McGregor will benefit if the euro depreciates. So I'll just, mention what the situation is here. So there is a company called McGregor. McGregor, right? So there's a company called McGregor. They are in a land called Zealand, and their currency is the dollar. Fine. They have supplied goods to a customer in another country. Now, if you are supplying goods to a customer in another country, guys, we are exporters, right? Remember that. Okay. And who is my customer? In the country of Duro, have they given the customer's name? No. They are in Duro, which is in Europe. So obviously, they are using the euro as the currency. That's fine. Okay. So we are exporters. Remember that. Now, I always, when I teach this, I tell you, remember or think of somebody you know who is an exporter. Okay. Now, usually exporters, when the entire country is unhappy, they will be happy. When the entire country is happy, they will be unhappy. Okay. The reason for that is, when will the entire country be unhappy? Now, take Sri Lanka for example. When the dollar became 400 rupees, everybody is unhappy. Why? Because if you're going to buy something from abroad, it's going to cost you more. Whereas somebody who is exporting will be very happy at that time. That means when our currency is depreciating, they will be happy. Why? Because they will be able to earn more rupees because their customers are paying them in dollars now. So the moment the dollar becomes 400, 500, they get more rupees. So they will be happy. So usually exporters will be happy when their currency depreciates. So when will this exporter be happy? When the dollar depreciates, or in other words, the euro appreciates. In these two situations only, the exporter is going to be happy. So I will say happy over here. Meaning they will benefit. Okay, right. So let's see what the question is saying. The interest rate parity theory states that the forward exchange rate is based on the spot rate and the interest rate differential between the two countries. Whenever you have interest rate parity and stuff, don't worry because the question, the formula sheet is already given to you, right? So let me go there. They're talking about the interest rate parity. So forward rate is the spot rate multiplied by the interest rate differential. That is exactly what the interest rate parity is, right? So this is true. Second one is saying McGregor will receive more dollars if the euro will depreciate in 4 months' time against the dollar. So what are we trying to say? The euro is depreciating means the opposite to what I have typed is happening, right? So if euro depreciates, the dollar is appreciating. Okay, so if the dollar appreciates, remember, they won't be happy. They are in the US, but when their currency strengthens, they won't be happy. Why? Because they end up receiving less. So they're saying McGregor will receive more if the euro depreciates. That's wrong. They will receive actually less if the euro depreciates. So this will be false. Always remember that, right? Exporters will be happy when their currency depreciates and importers will be happy when their currency appreciates. Just remember one of the two. The other one will obviously be the opposite. Okay? Right. Which of the following would McGregor face regarding the euro receipt? So what is the problem that they have there? They are going to receive 2.1 million in 4 months' time. Current spot rate is this. Short-term interest rates are given. The problem is now this 2.1 million you're going to receive in 4 months. No. So will you receive less or will you receive more compared to today? That's the risk. That's a classic example of transaction risk, right? Translation means the risk where if you have a foreign subsidiary, when you're converting their accounts to your currency, there might be a translation or a foreign exchange loss or gain. So that is the translation risk. Business risk is the risk that you face to operate in that industry. Economic risk is the long-term version of transaction risk. So that is something that will impact everybody. So now, for example, the Sri Lankan Sri Lankan rupee depreciated. That is going to affect every business, right? So that is the long-term version of transaction. For this, it is a one-time transaction we're talking about. So it's called transaction risk. Okay, what will be the 4-month exchange rate between euros and dollars, assuming that the interest rate parity holds good? So they're telling you to use interest rate parity. What was your answer? Do you have answers? Okay, so they're asking me to use the interest rate parity. So I will do that, right? If you don't know the equation, don't worry. It's already given here. So interest rate parity, right? So let me copy it here. The forward rate should equal to the spot rate multiplied by 1 plus the interest rate of the counter currency divided by 1 plus interest rate of the base. Okay. Right. So S naught, I think it's given to us there 1.3985. Okay. Multiplied by 1 plus interest of the counter currency. So actually our base is the dollar, right? So the counter currency is actually Zealand is our country, no? So 1.9 is our country at the base interest rate. Euro is only the counter. So that will be 3.75. Okay, so be careful in choosing the rates. 3.75%, but that is the per annum figure. Check how many months forward rate they want. They want a 4-month exchange rate. Okay, so careful. You have to multiply it by 4/12. Okay, divided by 1 plus interest in the base. So our country is Zealand. Our rate is 1.9%. But again, be careful. You have to multiply it by 4/12. Right. So that should give me the spot, the forward rate in 4 months time. Right. So that will be 1.407. Answer is there as B. Okay, so if you forgot that they're asking for the 4-month rate and you use the full rate, then you would get the wrong answer. Okay. Right. What's the next question about? Which of the following hedging tool will be useful for McGregor to hedge against the possible interest rate risk and the $2.1 million euro risk, right? So for the interest, what is the interest? We are considering raising funds to part finance its new project. So the bank has quoted a variable rate. Okay, so they are saying the risk is that today it's a particular rate, but if the base rate increases, we will end up paying more, right? So that's a problem. Then what is the 2.1 million receipt? You're going to get that in euros. So in case you get, when you convert that to dollars, in case you get less than what you will get today, that is the issue, right? So for the bank, they're saying buy a forward rate agreement and sell a euro at a forward rate. Okay. So if you remember, if you are in this case for interest, you're the borrower. If you're the borrower, you will have to hedge the risk by buying, right? So correct what they're saying, buy a forward rate agreement. So that's fine. Then the $2.1 million receipt, if you get euros in 4 months' time, obviously we will sell that, right? We can't buy euros now. We will sell that euro. So when we sell it, you will have to, if you want to fix a rate, then you can go for a forward rate agreement. So this first point, both seems to be correct. Buying the forward rate and selling at a forward rate. Buying the forward rate agreement for the interest and selling the euro at the forward rate for that forex risk. Okay. Let's read the rest. Sell a forward rate. So for interest, if you're a borrower, you don't sell, right? If you're a borrower, you have to buy the forward. So that's wrong. And if you're receiving euros again, you won't go and buy euros again, right? You will go and sell it. So this is the exact opposite of the correct answer. Then they're saying buy interest rate futures. Okay, so again, if you're a borrower, you will sell interest rate futures. Okay, and you won't buy dollar future contracts, right? Because we are getting euros. So that is also wrong. Then they're saying buy interest rate call options, right? So that is also wrong. You have to buy interest rate put options in this case, right? So the best option that we have and the correct answer there will be A. Okay, so you have to learn everything to do with all of these different instruments, right? Because if you didn't know about the call options and the put options and the futures, how they work, like you should know which one you should, whether you should sell and buy or buy and sell, those orders, you have to learn it properly. Okay. Right. So let's move on to the next one. Assuming that the expected exchange rate is 1.4070 in 4 months' time, calculate the gain or loss for McGregor Company if it had hedged the 2 million receipt today using a forward rate of 1.3995, right? So it's like this. If they had gone for a forward rate of 1.3995, regardless of what the market exchange rate is in 4 months' time, they have to honor this contract. They will have to do the conversion at 1.3995 only. So now what we have to see is, are they going to lose or gain from this particular forward contract? Okay, so let's see. So take out your scratch pad. We're still on this question now. So what are they saying? They're saying, if we had hedged it using the forward rate. So forward rate means you will get the $2.1 million receipt, right? So since they're saying to the nearest dollar, I'll just put it as whole figures, right? Just to be safe. This amount, I will have to convert it to dollars using this 1.3995 rate, right? So if I do that conversion, 1.3995, how many dollars will I get? I will get $500,535.91. So I will get this amount only. I can't change that. Okay. But suppose I didn't enter into this forward contract, then how much will I get, right? So if I was to convert using the market exchange rate, then I can take the 2.1 million, divide it by, they're saying the market exchange rate, we're expecting it to be 1.4070. Okay, so that is 1,492,537.31. Okay, so currently I am converting at this rate, but if I hadn't got into that exchange contract, that forward contract, I will only get 1,492,537.31. So actually, it's good that I went for the forward exchange. Okay. So what is the difference between the two? 1,500,535.91 minus 1,492,537.3. Okay. So the answer there, they're saying to the nearest dollar, right? So let me check. Yeah, that will give me $799. $7,999, 7,999. Okay. I just put that figure there. You can take it down if you haven't. Okay. So that wraps up McGregor Company. So nothing complicated with regard to McGregor. Okay. So it was a foreign exchange. It was a risk management based question. But actually calculations wise, it was only the forward rate and the interest rate parity theory. Other than that, everything was just theory. Okay. Okay. Since we have 15, almost 20 minutes, we can, I think, finish off the third question also. Okay, so let me move on. Right, so we're talking about a company called Green Company. Okay, so I'll just read through the requirements. First, they're asking for a receivables collection period. Then they're asking for a payables payment period. Fine, so I'm already happy. Then they're asking something to do with JIT. Okay. Economic order quantity. Okay, I'm very happy now. All four I seem to know it. And then they're asking the annual effective cost of the discount. Okay, so everything seems to be okay to me, right? So let's start. So question 26. Even for correct answers, yeah. It's a practice platform, no Akib, right? So as in, see, at least they gave us this platform. Okay, think of it that way, because if we didn't have access to this was not there, right, until recently. So students had to go for exams, and then only they will have to figure out, this is how it's supposed to look like. Right, so at least they're giving you the opportunity now to try out a mock exam in this platform. So that's there. Obviously, it has its problems. Okay, so that I also agree. Okay. Right, so it says here, Green Company needs help in calculating various ratios and holding periods to better manage their working capital. An extract from the accounting records for the latest financial year is as follows. So you have the receivables, you have the inventory, the trade payables, sales, and material purchases. Everything is there. Assume that there are 365 days in a year. Green is also looking at introducing a just-in-time inventory management system in its operations, and the management wants to get an understanding of the aims of that system. Okay, fine. So they're asking first calculate the accounts receivable collection period from the table above. So accounts receivable collection period, right? So receivable days basically. That is what your receivables divided by your credit sales into 365, right? So receivables, I have it 450. Okay, so I can just take it. Credit sales, they're telling me 1,500 is your total sales. From that, 75% is on credit, right? So 1,500 into 75%. That you multiply it by 365, that answer. So that should give you your receivable days as 146 days. Okay, so that's easy. 146 days. Next, payables payment period. Okay, so same thing. Payable days, right? So payables payment period. That's going to be your payables divided by your credit purchases into 365. So payables, I have it as 180. Divide that by my credit purchases, right? So I have material purchases as 1,200. I will only take the credit, right? So 60% is only credit. That you multiply it by 365 days. It's 91.25 days. So round it up, 91. The answer that we have is 91. So we select that. Okay. So first two is an easy 4 marks. Okay. Only thing is you should know that this is credit sales and credit purchases, not the entire sales and entire purchases figure. Right. Which of the following systems are attributable to JIT inventory management system? So I hope you already know what is JIT, just in time. So basically you do the production only after the customer places the order. Okay. So not just the production, even you buying the goods, placing the order with the supplier. Your supplier happens only after the customer places the order. So first is saying JIT aims to make the production process flexible by making it responsive to customers' requirements. Okay, so that is actually correct, right? JIT, our production process has to be flexible. It has to, if I ask my workers work for extra hours, they should be okay with that. If I ask my supplier, can you send the goods within 1 day? He should be okay with that. So flexibility has to be there, because only if flexibility is there, will you be able to produce the product quickly and give it to the customer. If not, customer will have to wait for months and months for the product. So first is correct. The process has to be flexible. Second is saying the main aim of JIT is to calculate the optimum order quantity to be ordered for raw materials. That is not JIT. We all know that is economic order quantity. Okay, so that is definitely wrong. So here itself, you are eliminating the first one and the third one, right? So it's either 1 and 3 or 1 and 4. The system aims to reduce capital tied up in inventory. That's true. We don't want to have inventory just waiting in our warehouse. That's the main reason why we want to start the production itself after the order is confirmed. Okay, so that is correct. So the answer is 1 and 3. I'll eliminate the fourth one also. A JIT manufacturer looks for a single supplier who can provide the lowest price rather than high quality, frequent, reliable deliveries. Okay, so everything there is wrong. Now, if you're a JIT manufacturer, nobody told you you should only have one supplier. You can have 1, you can have 10, you can have 100. That's fine. But we are not focusing on them giving us lower price. They can charge us a higher price. That's fine. But we need quality and frequent deliveries and reliable deliveries. Now, if they are going to delay it, say I place the order and the supplier is giving me the product only after 1 or 2 months, that is not good for me, for JIT, because then after that I have to produce, then I have to give to the customer. That will take a very long time. So we are very focused on deliveries being, reliable. So definitely that is a very wrong point to make, right? So fourth one, everything about it is wrong. Okay. So the correct answer will be 1 and 3. Right. Then it says, the monthly requirement of one of the materials is 5,000 units. Purchase price is 12 per unit. Green company's cost of capital is 10% per year. Storage cost per unit is 1.75 per unit per year. And the vendor charges $175 per order for each delivery. What will be the EOQ to the nearest of 1 unit? Okay. I don't think I can put roots and all here, right? Let me see. I can't find the square root sign over here. Yeah, so anyway, economic order quantity, this is the equation, right? So EOQ equals to the square root. I don't know how to put that. So I'll just put it as to the power. No, I can put it as to the power 1/2, but I don't want to confuse you. So let me just, for the time being, all of you know now what's the EOQ. So I'll just show you the formula sheet, right? So EOQ formula is this, right? The root of 2 times the cost of ordering times the demand into the cost of holding, right? So, right, 2 times the cost of ordering. They're telling me purchase price is 12. Cost of ordering means we're talking about delivery, right? So, vendor charges 175 per order for each delivery. So, that will be the cost of ordering multiplied by the demand. But remember, it's annual demand. We know that monthly demand is 5,000. So, that 5,000, you have to make it annual. So, multiplied by 12. Okay. So, that's the numerator. Divided by the cost of holding. So they're telling me the storage cost per unit is 1.75. That's fine. Is a trick here. Okay. What's the trick? Usually we only consider the storage cost. Okay. So the cost of keeping it in your warehouse. But you already know this, right? That when it comes to cost of holding, we include rent, which may be this 1.75 plus any finance cost. Okay. Now, in this question, they're giving me the cost of capital. There's a reason for that. That means they are saying we are financing this using a loan. So, that is why a loan or maybe equity, whatever it is, we are taking a loan or equity and then only financing this particular purchase. So if the purchase price is $12, the interest that you're paying, which is 10%, has to be considered as the cost of holding. Correct. We need to consider finance cost also when you're considering cost of holding. So we will consider that, which is 12 into 10%, which is the finance element. Okay. So usual questions so far, you might have not seen this because they don't give that data. But here, since they're giving you the cost of capital, that is a hint to show that you need to consider the finance cost also. Okay. So whatever answer you get here, you should get the square root of that answer, right? So let me just put it in the cal. The root of 2 times the cost of ordering, which is 175, into the demand, which is 5,000 into 12, over 175, sorry, 1.75, plus 12 into 10%. I'll just put it as it is, so it's easy. Okay, so that is what I have written there. Okay, so I'm sorry, I can't put it properly in this sketch pad. So that will be 2668.08. They asked me to give it to the nearest of 1 unit, so that's easy, 2668. Right? So take this down if you haven't. 2668 units. Sure, you can reduce the size of this. Right? So one last question to finish off this particular MTQ as well. This Sunday, yes, Sakit, we will have a class. Okay, it's till August now. Yeah, check that. Yeah, we will meet 25th, yes. What will we do this Sunday? Yeah, so I will finish this chapter, sorry, this, what do you call? The pre-mark of the next TRG. But at the same time, there will be, within the next 2-3 days, there will be a video that I will release on the LMS, right? So if you want, you can use that to mark section C. On Sunday, I will find another paper and we will go through that. Okay, so maybe we will do, we won't be able to complete the entire paper, but we will do bits and pieces. Okay. We have enough and more questions to do, right? So don't worry about that. Right. So that's that. The next one, you can try it out and give me your answer. So next TRG will be the discussion of section C, correct? So we will only do section C and probably call it a day, right? Because I don't want to load you too much because next TRG is the last class now. So we can finish it off and maybe we'll do a light MTQ. But I want to discuss more than that. Next Sunday, I will have another paper, right? So I have another paper that I have in mind, which we will do. Okay. Right. So they're saying here, Green Company is considering to offer a cash discount of 1.5% to a specified segment of customers if they pay within 60 days, okay? Currently, they pay within 90 days. Assuming 360 days in a year, what is the annual effective cost of this discount, right? So this is EAR, right? If you remember, effective annual rate. So you need to use that equation. So I hope you guys remember this. The effective annual rate equals to 1 plus the normal monthly rate or whatever rate. Okay, that to the power n minus 1. Okay, that is only the effective annual rate. So now we need to get this monthly rate or whatever rate they're talking about. So they're saying we are going to give a discount of 1.5% to a specified customer set, right? Now, if you're giving them 1.5% discount, guys, now say it was a $100 invoice. You can assume it's a $100 invoice. 1.5% discount means I get to hand only $98.5 dollars. Right? So 1.5 divided by 98.5, we are talking about how much? A discount of 1.5228%. Okay? Right. Now this 1.5228, guys, they are going to pay within 30 within 60 days. No. Okay. So usually they used to take 90 days. Now they are going to take 60 days. So this is a discount for a period of 30 days, the difference. Okay, it's a difference of 30 days. So because of this, they are going to pay 30 days earlier, right? Fine. So now when I want to know the effective annual rate, that will be 1 plus this rate, which is 1.5228%. To the power n is the number of periods in a year. Now this is a period of 30 days, right? So in a year, how many 30 days will you have? 360 days in one entire year. If I divide that by 30, basically 12 months, right? So 360 divided by 30. Okay, so this 1 plus 1.5228% to the power 360 divided by 30. I don't want to put it like that. That is basically 12. Okay, minus 1. That will give me the effective annual rate. So that will be 1 plus 1.5228% to the power 12 minus 1. Okay, so as a percentage, the effective annual rate is 19.88, which is equal to 19.89. So 2 decimal places. Sorry. So do we have that answer? 19.89. Yeah, here D. Okay. So you need to know this equation. If not, you will get a little confused. Usually there is always one question to do with this area in a paper. You notice even in the Marches pre-mock they included it. Even September they are including it. Okay. So the best way is to remember the equation. You won't go wrong. Okay. Right. So that sums up this green company. Right. So just to finish it off. Yeah. Next is section C. Right. So even to go back, I have to look, right? Okay. So in case you haven't taken down the AR, take it down. After that, you can leave, right? So that's it for this TRG. Again, I know I gave this as a mock, no? So in the remaining 2 to 3 days, there will be a video that's released. Once you mark your section C, please, the two of you, send your marks to me. Okay, so I can document that. On Sunday, I said we will do something else. And on Monday, I will finish off the section C because this is also streamed on YouTube, no? So it will benefit other people as well. Okay. Right. So if you're done with this, that's it for the day. I'll see you on Sunday. Okay, no problem, Amna. Right. So I think you guys should be done now. I will see you on Sunday. Right. Good night.